Hey guys, hope you're doing well out there. Time to take a look at Adobe as shares are falling nearly 11% in the after hours. That is on the heels of reporting their Q1 results. We'll take a look at it from a revenue, earnings, and cash flow perspective. We'll jump into all the financials I think you need to know over at Adobe. We'll then also look to answer the million-dollar question I think that surrounds this company and really surrounds the stock, is that will AI be the end of Adobe? And will this business model really be one of the first businesses to be properly disrupted by AI? We'll look to answer that. And then, as always, this channel isn't called the stock study for no reason. We'll highlight some levels if you're interested in picking up shares of Adobe where I think it would make sense to step in and be a buyer. As always, if you're new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Shares of Adobe coming down to $507 in the after hours. That is despite rallying nearly 70% over the past 1 year. But year to date, this stock has really struggled and hasn't picked up the rally of the NASDAQ, as shares are down nearly 5%. And then you consider the after hours decline of 11%. Likely this one's market cap tomorrow will be near $225 billion. And so that will be a year-to-date decline of close to 10 to 15%. So keep that in mind. Shares of Adobe really feeling the pressure. And I think a lot of it comes down to that question of will AI disrupt this business? And we'll get to that in just a second. But before that, Q1 revenues over at Adobe came in at $5.18 billion. That was good for 11.2% growth year over year. That did beat estimates on Wall Street that I think were coming down slightly over the past few days. That did still beat them by roughly $30 million. In terms of non-GAAP EPS, that came in at $4.48. Estimates were closer to $4.38. And so that beat estimates by right around 10 cents. From a cash flow from operations, this is a figure they provide. I think cash flow is super important for this company. We'll take a look at that more later in the video. Cash flows in this most recent quarter coming in at $1.17 billion. That's cash flow from operations. But consider this company is a very high margin business that really does very minimal capital expenditures. And so with minimal capex, your free cash flow for the quarter is also likely right around $1.17 billion as well. Now, I think the main reason why shares are falling in the after hours is because of a slightly lower guide, at least on that top line. Adobe guiding for top line revenues in this upcoming Q2 to come in between $5.25 up to $5.3 billion. The average consensus on Wall Street was closer to 5.31. And if that's the average, you know, there's a lot of estimates on Wall Street that are higher. As you see, the high end on Wall Street for this upcoming Q2 was supposed to be 5.45. Adobe guiding in the range of 5.25 to 5.3 is actually just higher than the low estimate on Wall Street. Now, this range isn't extremely big, but considering Adobe has a pretty good outlook on their upcoming quarters and really on the upcoming years, as you see, this company has a ton of remaining performance obligations. They have a ton of recurring revenue. And so they have a pretty good outlook on what their upcoming quarter should be like. So I think Adobe, when they guide for a number, let's say between 5.25 and 5.3, I'm pretty sure they'll likely come in right in the range of that. And so from that perspective, it is slightly lower than the consensus street estimate on that revenue side, likely causing shares to fall. I think a 10% reaction, though, just because of this, is slightly of an overreaction. I think it does ultimately come down to that AI question. From a non-GAAP EPS guidance perspective, they came in at $4.35 to $4.40 on that guide. Estimates were closer to $4.37, so right in the range of Wall Street guide from that EPS side. As we saw, the revenue guide coming in slightly short, that would still represent right around 10% growth, actually just underneath 10% growth based on what Adobe is guiding for the upcoming quarter on that revenue side. And then on the EPS side, they're expected to grow in that low to mid teens. And really that's where the growth is expected to be over at Adobe. Really, as we look ahead to the next 8 quarters, they're really expected to grow in that low double digits range in the foreseeable future. And ultimately what that does is bring down this company's forward price to earnings. It simply just doesn't demand the same multiple that it did once in the past. We pull up a 10-year price to earnings historic basis for Adobe, and you see historically this company likes to trade near a 50 times price to earnings. In the past, it has gone as high up to nearly 70 times and then has come down closer to 28, 29, 30 times a price to earnings. But considering this company is trading at a forward multiple of 32 times, might seem cheap, at least historically. But consider this company is expected to only post low double-digit growth for the foreseeable future. And so really they won't have the same growth rates that they once had in the past. And so ultimately that won't demand the same price to earnings multiple. I think a 30 times still is not wildly overvalued over at Adobe, considering how good their margins still really are. And considering this is a software as a service business with a ton of annual recurring revenue, we have a level of predictability with Adobe's earnings. And so I think for that, you pay a premium. And I think 30 times is close to fair, in my opinion, for a forward price to earnings for Adobe. And so just from an earnings perspective, I think this is a fair amount to pay for Adobe. Now, I think the main reason why shares are selling off still so heavily in the after hours is despite that lower guidance on that revenue side, I think a lot of concerns for investors come from this question of will AI be the end over at Adobe? And in my opinion, I believe the short answer really is no. And that is for a number of reasons, which I'll get into. So first of all, Adobe, in my opinion, is embracing AI. Instead of going down the route of saying that AI is not going to affect their business model and they don't really need to worry about AI affecting their products, I think Adobe is going down the route of embracing AI, which is the correct way to go about this. As we see, they have a flagship AI product at this point called Adobe Firefly, and they've integrated generative AI across different image models and vector models along with different design models. And then on top of that, they have a generative AI assistant along with Gen AI summaries. And this is from their latest press release, Adobe announcing that they'll incorporate an AI assistant in part of their Document Cloud and Acrobat and really their Reader products. And so Adobe is going down the route of embracing AI as they look to put that into the majority, if not all, of their Creative Cloud and Document Cloud applications at one point or another. And so I think Adobe embracing AI is showing that this is a company that's able and at least willing to keep up with the times. If they were going down the route of saying that AI will ultimately not take away their competitive advantage, I think at that point I would be more concerned. And I do want to describe what I mean by AI in this sense. For specifically for Adobe, I do mean AI to be text to image or text to video large language models. That is specifically what I'm referring to when I say AI, as I think that's the biggest threat to Adobe's business is other startups and other companies developing their own text to image and text to video large language models. Now, I think the second reason why I think AI won't be the end of Adobe, as so many are fearing, is because Adobe has the enterprise customer reach that really I think any company that's developing these large text-to-image large language models really want. I think Adobe has that. In this most recent quarter, they announced a number of enterprise wins, including Accenture, IPG, Starbucks, along with IBM, Nintendo, and Capital Group. And so these are just some of their new enterprise wins in this most recent quarter. And these are the enterprises that Adobe is allowing them to use their Gen AI and really adopting that into all of their existing clouds and existing applications that these enterprises really have been using for so long. And I think that enterprise customer reach is often far overlooked with Adobe, and it's really where their strength comes from. And especially if you think of it from an enterprise's perspective, if they're already using a ton of Adobe's products and Adobe's Creative Cloud suite, then on top of that, if Adobe is incorporating AI into those products and applications, why would an enterprise choose to go out and use a new startup or a new company's text-to-image model when they can just use Adobe's that's already incorporated as part of their subscription? Or if they have to pay a additional fee on top of their existing subscription to Adobe, I think they're much more willing to do that, especially from a perspective of an enterprise. I think oftentimes these stories of will AI be the end of Adobe come from the perspective of individual customers, and certainly to a certain extent freelancing is a target market for Adobe, and certainly they have a ton of freelancers that use their Illustrator and use their Creative Cloud suite. But I think the large majority of their profits and at least those annual recurring revenues in the hundreds of millions, if not billions of dollars, come from these enterprise customers. And what these enterprise customers ultimately want is stability. They want trust. They want an application that they're familiar with. And now they want that incorporated with AI, which is exactly what Adobe is doing as they embrace AI into their Creative Cloud. So I think having that customer reach on the enterprise level certainly will be beneficial for Adobe, which I think not a lot of other smaller companies, at least in the space, currently have. Now, my last point is that I think Adobe will come out on top as AI becomes more regulated. And I think this is a key point that's, again, often far overlooked in the debate of will AI be the end for Adobe. And specifically when it comes to Adobe, they have said that they're taking a highly differentiated approach across data, models, and interfaces. And really, as we know, the backbone of all these large language models and text-to-image models is really data. It all comes down to having the right data and really being able to use the right data. And the way Adobe is approaching this is they're going through an IP-friendly approach, otherwise known as intellectual property-friendly approach. And so why that's important is because as we enter the age of AI becoming more and more regulated, look, right now we're still, in my opinion, in the very early innings of AI, at least from a software perspective. You have companies like NVIDIA that have been making progress on AI for many, many years, but that's more so on the hardware side. In my opinion, on the software side, I think we're still very early on in terms of the benefits and reach of AI. And so we will no doubt have more and more regulations be passed down in Washington when it comes to the use and the spread of AI. And as these text-to-image and text-to-video models become more and more mainstream, I think there will be a certain level of regulation in terms of what licensed and non-licensed images and really videos someone can use and create. And ultimately, again, that comes down to data. The fact that Adobe will be using non-licensed material across their creative and document suite, I think that's important for creators, and especially, again, important for enterprises. An enterprise that is using Adobe's suite doesn't want to get caught up in the litigation that may come from using text-to-image models that may be used copyrighted or licensed materials, which I think a lot of these startups and other companies that have their own text-to-image models, I think a lot of them do use data available on the web, and a lot of that, again, is licensed and copyrighted. And so Adobe going down the route of using copyright-free and really non-licensed materials as part of their data, I think will ultimately be a big reason for why enterprises choose to pursue Adobe's products over another companies or another startups. As AI becomes more regulated, and I think as those bills in Washington get passed down on what copyright material can and cannot be used for these large language models, I think that's where Adobe's strength in terms of their AI within the applications will, I think, really come and shine through. And so that was my take on this question of, will AI be the end of Adobe? In my opinion, I don't think so. I think Adobe is going down the correct route of embracing AI and incorporating it into its applications. And I think from that perspective, AI will ultimately help Adobe more than it will harm it. Now, I'm sure there's a number of valid reasons why I think a lot of people are fearing that AI will be detrimental to Adobe more so than helping it. And certainly if you do believe that, let me know in the comment section below. Would love to hear your thoughts on why it is that you think AI will ultimately harm Adobe more so. Moving on to the financials, this is a company that's actually quite stable and predictable. And so as we go through these financials year over year, even over the quarters over at Adobe, the numbers don't really surprise investors all too much. We have a total revenue figure of $5.18 billion. Last year, you were closer to $4.65 billion. So you have that near $500 million incremental jump on your total revenues, the majority of that coming from your subscription revenues. And then on top of that, you have your cost of revenues hardly budging up from $568 million up to $590 million. And so from your gross margin perspective, this company is sitting on nearly 87% gross margins as you net out nearly $4.6 billion of gross profit from $5.18 billion worth of revenues. And so from a margin perspective, this company is absolutely stellar. Now, where things change in this most recent quarter is when we come down to your operating expenses. You see R&D did tick up right around $100 million. Certainly when they're investing so heavily into their AI suite of applications, I think a tick up in R&D is absolutely expected. Your sales and marketing budged just a little bit, G&A also moving up just a little bit, but you do have this acquisition termination fee of nearly $1 billion. That is a large fee on $4.5 billion of gross profit. You pay $1 billion on an acquisition termination fee. And this acquisition termination is from Figma, that $20 billion acquisition that Adobe announced, I believe a few years ago, that was expected to go through, was called off last quarter, I believe, in December by the regulators over in the EU and UK, largely due to anti-competitive and monopolistic behaviors. I think they largely saw Adobe picking up Figma as pretty anti-competitive, considering they both sort of make really good design software. And so your total operating expenses came up to $3.68 billion. Last year, you were at 2.5. And so if you strip off this $1 billion acquisition termination fee, you're basically looking at a $100 million bump up in your operating expenses. That is certainly doable, considering you're spending a little bit more on your R&D as you should. This acquisition termination fee certainly hurting Adobe. Now, in my opinion, in the long term of things, I think this is actually a good thing for Adobe. In my opinion, that Figma deal for nearly $20 billion, which was 50 times sales on Figma's annual revenues, which is a hefty premium that Adobe was willing to pay. I think that $20 billion for Adobe to finance that deal would have really blown up this company's balance sheet, and they would have likely taken on a ton of debt, would have likely done a lot of shareholder dilution. And so in my opinion, Adobe kind of dodged a bullet where the EU sort of blocked their deal and Adobe didn't really have to pick up Figma. Certainly they have to pay this $1 billion to Figma, which I'm sure they're quite happy about over at Figma. But in my opinion, Adobe picking up Figma wouldn't really have made all that much of a difference, considering this company does have a ton of in-house or in-suite of applications that really do a similar thing. And I think over time they can maybe create a pretty solid competitor to Figma rather than having to acquire the company outright. And so while it's still $1 billion in this most recent quarter, while this will affect their cash flows over the course of this year, I think it's a heck of a lot better than having to pay $20 billion for a company like Figma that's doing $400 million worth of annual revenue that's over the course of a full year. And so I think in that perspective, Adobe did dodge a bullet. And so because of this $1 billion acquisition termination fee, their operating income did come down to $900 million last year. You were at one point, call it $6 billion. And similar story painted on your net income, as that's down to $620 million last year. You were at $1.2 billion. And so really, if you add this acquisition termination fee right back on top of their net income actually would have grown pretty nicely up to 1.6, up from 1.2. And so do consider that when you take a look at numbers like this, you see on a year over year, the net income looks quite ugly, and certainly that would be represented in their GAAP figures. But in terms of a non-GAAP figure, I think that's really what you should be looking at for Adobe, especially for a one-time charge like this $1 billion. Coming down to their balance sheet, Adobe sitting on roughly $6.25 billion worth of cash and cash equivalents. That is down a little bit from a year ago, which was at $7.14 billion. When we come down to cash flows, we'll see how they spent their cash over the last 3 months. From a current assets perspective, also coming down to $10 billion. Last year, you were closer to 11. From a liabilities perspective, you're sitting on roughly $9.5 billion worth of current liabilities. You do have roughly $1.5 billion of short-term debt. Looks like that just rolled over from their long-term debt. As you see, that's down roughly $1.5 billion. And so they have about $1.5 billion of debt maturing over the next 12 months, at least in calendar year 2024. And so they'll look to likely pay that off, sitting on well in excess in that cash pile. And so that should be of no problem for Adobe. All things considered, balance sheet looking fairly healthy. You're sitting on roughly $28 billion of total assets, balanced out with just $13 billion of total liabilities. And so from a balance sheet perspective, again, this company's balance sheet looks actually pretty good. Now consider if you were to do a $20 billion acquisition for a company like Figma, just how you would fund that. They would have to raise a ton of debt and likely do a ton of shareholder dilution in order to just finance that $20 billion. And especially considering Adobe would have to finance those $20 billion at a time when interest rates are honestly very high, that would have been pretty painful, in my opinion, had they had to finance those $20 billion. Lastly, from a cash flow perspective, you see that net income figure did get cut in half, as we talked about earlier, largely due to that acquisition termination fee of $1 billion. You still had very strong net cash provided by operating activities at right around $1.17 billion. Last year, you were closer to $1.7 billion. And at the top, we mentioned this company really doesn't do a ton of CapEx. And so your operating cash flows is basically the same as your free cash flows. And you're looking at roughly $1.2 billion in terms of free cash flow for this, or call it $1.1 billion of free cash flow for this most recent quarter. And in my opinion, as we go through Q2 to Q4, they'll likely see a figure closer to this $1.7 billion in free cash flow. And so from that perspective, this company, you annualize that out right around $6.2 billion in free cash flow for a market cap closer to we'll call it $225 billion, based on probably the fall that this company will experience tomorrow. You take a $6.2 billion free cash flow figure and you divide that by $225 billion of market cap, you're looking at nearly a 2.8% free cash flow yield for this company at this current time. And so from that perspective, not the best deal from a free cash flow perspective, but certainly not terrible either. I think this company, as it comes down in price and will likely continue to raise their free cash flow, I think if you get this company closer to a 3% free cash flow yield, from that perspective, I think Adobe makes a lot of sense. Now we see Adobe did repurchase nearly $2 billion worth of common stock in this most recent quarter. That is accelerated from last year, where we were buying back roughly $1.4 billion. And so that is where the majority of their cash decrease came in. They bought back roughly $2 billion worth of stock. And when you generate just $1.1 billion of operating cash flows, you'll likely have to spend nearly $900 million from your cash pile in order to complete that buyback. In this most recent quarter, they also announced an additional $25 billion buyback that will extend over the next 4 years for Adobe. And so expect this company to continue to buy back those shares, especially as these shares fall. They'll likely continue to accelerate the pace of that buyback. And speaking of shares falling, this company trading down to $507 a share in the after hours, you see has come down to right at this support line at basically on the nose at $507, $508 a share. This company was making a pattern of higher highs and higher lows really dating back to June of 2023. So basically for almost a year was in a pattern of higher highs, but has certainly broken through that in a pretty decisive manner, in my opinion. Now, certainly Adobe could come in and see a reversal at these levels, could see support right at $507 a share. And certainly if the stock does bounce tomorrow, I think that would be a good sign considering it had found a level of support. But if Adobe does break through this $508 level, I think there is a pretty good chance it's coming all the way down, at least somewhere in this range of $440 up to $500 a share. I think this is your next level of consolidation for Adobe. It really made this monster move higher and then consolidate at a higher level, and then now has broken down back into that range. And really this was a level where Adobe consolidated a ton back in 2021 and 2020. And so really if it comes down to that level, it'll really come back to a point where there was actually a good amount of demand and supply for these shares. And so that's really where I would expect Adobe to come in and consolidate somewhere between $440 up to $500 a share. This is really where I would consider being an acquirer of shares of Adobe. Certainly for a stock like this, when it goes through periods of consolidation, I think that's when you pick up a position in Adobe. And really anytime it comes down closer to the bottom end of that channel, or at least bottom end of that range, that is when you would look to acquire shares of Adobe. I think from a free cash flow perspective as well, we were talking, this company trades at roughly a 2.7% free cash flow yield. I think another 10 to 12% drawdown from where the stock is in the after hours, that would bring your free cash flow yield north of 3%. And I think that's where shares in Adobe really become attractive. I think this one in the mid 450s, that is really where you would look to begin a position in Adobe and maybe look to acquire it at the bottom end of this channel. This company is also right now making a pattern of lower highs and lower lows, likely to be confirmed tomorrow. And so from that perspective is in a short-term technical downtrend. And so that is something you should keep in mind. Overall, I would wait for the stock to sort of level out and consolidate, ideally between this $440 up to $500 range. That is really where I would be interested. That was my take on shares of Adobe. Let me know your thoughts on this one in the comment section below. It's also based on the thesis that I think AI really won't be the end of Adobe, and I think this company will adapt to embrace AI and really incorporate that into its suite of applications and ultimately win those customers and enterprises that Adobe really needs. And this company will continue to chug out those earnings and profits. And while it may not grow at the same clip it once had, I think the valuation also isn't as wildly expensive as it once used to be. And so from that perspective, I think Adobe can make a lot of sense from a buy and hold perspective as it comes down in price. That was my take on shares of Adobe. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.